influencing the overall level of interest rates in the economy. My experience in government, including the U.S. Treasury and elsewhere, is that institutions work best when they focus on a limited set of understandable goals and are held accountable to the public for achieving these goals. As the number of goals and the lack of clarity increases, the effectiveness and the performance generally decline. My second concern is that responsibility for these new Tier 1 financial holding companies would reduce credibility of the Federal Reserve by involving it directly in potentially controversial decisions. In fact, it seems to me the experience of the last few months illustrates this problem. The Fed's credibility is an extraordinarily valuable asset, and it would be terrible to lose that asset. My third concern is that the plan would create a conflict of interest. Indeed, this has been discussed widely already at this hearing with the Vice Chairman and others. In my view, firms in the Tier 1 financial holding company category would be perceived as too big to fail, and perhaps even too big to resolve to go through that complicated process that's being proposed. In my view, there will therefore be a temptation to adjust the instruments of monetary policy, the money supply or the interest rates, to help protect these institutions. It's a natural evolution. Lower interest rates, when they're not appropriate, will be harmful to the economy, and a larger Fed's balance sheet, when not appropriate, would be harmful to the economy. My fourth concern is that by giving so much new power to the Federal Reserve, the plan would actually threaten the Fed's independence regarding monetary policy. Why would this be the case? In my view, sooner or later, the increased power will result in checks and limits on it, perhaps through micromanaged political interference or perhaps through legislative changes. It would be impossible, as some have suggested, in practice to prevent such interference from spreading from the new regulatory powers and supervisory powers to the traditional monetary function of the Fed. After all, they are in the same institution and they're run by the same CEO. I think this loss of Federal Reserve independence is a serious issue, especially at this time of rapidly growing federal debt and greatly expanded Federal Reserve balance sheet. Actually, I could not do any better than to quote a former Secretary of the Treasury, also former Secretary of State, Secretary of Labor, and Director of the Budget, Secretary George Shultz, who, after studying carefully the events of the last few months, came up with the following statement, and I quote Secretary Shultz: "Observing this process, the question comes forcefully at you. Has the accord gone down the drain?" The Secretary, of course, is referring to the 1951 accord, where the Fed regained its independence from the Treasury, which had lost during World War II and was committed to pegging Treasury interest rates. And then he goes on to say, and remember how difficult it was for the Fed to disentangle itself from the Treasury in the post-World War II period. So these are very serious concerns, my four concerns, and I'd be happy to answer any questions you have about them. Thank you, Mr. Chairman.
Thank you, Dr. Taylor. Dr. Meltzer, you're recognized for 5 minutes.
Thank you, Chairman Watt, and greetings to my old friend, Congressman Ron Paul, and to the members. Thank you for the opportunity to present my appraisal of the administration's proposal for regulatory changes. I will confine most of my comments to the role of the Federal Reserve as a systemic regulator and will offer an alternative proposal much closer to the Republican proposal. I share the belief that change is needed and long delayed, but appropriate change must protect the public, not the bankers. During much of the past 15 years, I have written 3 volumes entitled A History of the Federal Reserve. Working with 2 assistants, we have read virtually all of the minutes of the Board of Governors, the Federal Open Market Committee, and the directors of the Federal Reserve Bank. We have also read many of the staff papers and the internal memos supporting decisions. I speak from that perspective. 2 findings are very relevant for the role of the Federal Reserve. First, I do not know of any single clear example in which the Federal Reserve acted in advance to head off a crisis or a series of banking and financial failures. We all know of several where it failed to act in advance. Congress members should ask themselves this question: can you expect the Federal Reserve or anyone else as systemic regulators to close Fannie and Freddie after Congress has decided that it declined to act? What kind of a conflict is that going to pose, and how is it going to be resolved? Second, in its 96-year history, the Federal Reserve has never announced a lender of last resort policy. It has discussed internally the content of such a policy several times, but it rarely announced what it would do. And the announcements that it made, as in 1987, were limited to the circumstances of that time. Announcing and following a policy would alert financial institutions to the Fed's expected actions and might reduce pressures on Congress to aid failing entities. Following the rule in a crisis, the lender of last resort rule in a crisis would change bankers' incentives and reduce moral hazard. A crisis policy rule is long overdue. The administration proposal recognizes the need but doesn't propose the rule. Experiences in the past from the history suggest three main lessons. First, we cannot avoid banking failures, but we can keep them from spreading and creating crises. Second, neither the Federal Reserve nor any other agency has succeeded in predicting crises or anticipating systemic failure. It is hard to do, in part because systemic risk is not well defined. Reasonable people will differ, and since much is often at stake, some will fight hard to deny that there is a systemic risk. One of the main reasons that Congress in 1991 passed FDICIA, the Federal Deposit Insurance Corporation Improvement Act, was to prevent the Federal Reserve from delaying closure of failing banks, increasing losses, and weakening the FDIC fund. The Federal Reserve and the FDIC have not used FDICIA against large banks in this crisis. That should change. The third lesson is that a successful policy will alter bankers' incentives and avoid moral hazard. Bankers must know that risk-taking brings both rewards and costs, including failure, loss of managerial position, and equity, followed by sale of continuing operations. Several reforms are needed to reduce or eliminate the cost of financial failure to the taxpayers. Members of Congress should ask themselves and each other, is the banker or the regulator more likely to know about the risks on the bank's balance sheet? Of course it is the banker, and especially so if the banker is taking large risks that he wants to hide. To me, that means the reform should start by increasing the banker's responsibility for losses. The administration proposal does the opposite by making the Federal Reserve responsible for systemic risk. Systemic risk is a term of art. I doubt that it can be defined in a way that satisfies the many parties involved in regulation. Members of Congress will properly urge that any large failure in their district is systemic. Administrations and regulators will have other objectives. Without a clear definition, the proposal will bring frequent controversy, and without a clear definition, the proposal is incomplete. Resolving the conflicting interests is unlikely to protect the general public. More likely, regulators will claim that they protect the public by protecting the banks. I think that's wrong. I believe there are better alternatives than the administration's proposal. First step, end too big to fail. Require all financial institutions to increase capital more than in proportional to the increase in the size of their assets. Too big to fail is perverse. It allows banks to profit in good times and shifts the losses to the taxpayers when crises or failures occur. Second step, require the Federal Reserve to announce a rule for lender of last resort.